Just give it another 10, 15 seconds to let people in, and then we'll get started. Hey, good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Tax Implications of Merger and Acquisition Transactions. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not for profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles, or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcast. Before I introduce our speakers, please pay close attention if you are an attorney or CPA in Connecticut, New Jersey, or New York and are taking this program for credit. I'll be giving out a code during this program that you'll need to write down. There will be only one code. It will be given at some point in the middle of the program, so have a pen and paper ready. After the program, you will receive an evaluation form where you'll need to insert the code in order to receive credit. Please stick around until the end of the program for further instructions on receiving credit. Today, we're privileged to hear from Avi Sinensky and Vlahos, both partners at Rivkin Radler based in Uniondale, New York. Avi's a partner at Rivkin Radler's corporate practice group with a broad-based transactional practice. He has extensive experience advising business owners and investors on a wide variety of corporate transactions and corporate governance matters across a broad range of industries and throughout all stages of the business cycle. Lou is a partner at the firm where he practices tax law and has extensive experience in corporate, individual and partnership income taxation, and in estate and gift taxation, including tax planning, ruling requests, and tax controversy. He advises clients in connection with corporate organizations and reorganizations, sales and acquisition of businesses, and estate and succession planning, including the transfer of business interests and estate and gift tax audits, New York business tax issues, charitable giving, tax-exempt organizations, private foundations, and not-for-profit restructuring. He frequently writes about tax law as it applies to closely held businesses. Today, Avi and Lou will be speaking on tax implications of merger and acquisition transactions. And with that introduction, I will now turn the program over to Avi and Lou.
Thank you, Jonathan. Always great to be back doing a webinar for ParkBridge. Great to see everyone. Good morning. And I'm extra happy to be here today with my tax partner, Lou Vlahos, because we're going to be talking about M&A transactions and the best way to structure those in order to promote tax efficiency. And anytime I get engaged on a new M&A transaction, almost as soon as I hang up the phone with the new client, my next call is immediately to Lou to say, okay, how are we going to structure this thing? What's the best way to achieve the best tax result for our client? Anytime a transaction is happening, tax is going to be one of the, if not the main primary driving force in how a transaction is structured, just because of the immense economic impact it can have on both parties. So I'm excited to dive into this. Just to kind of lay out the agenda for the next hour or so, we are going to first provide what I would call a basic overview of different entity types and some basic transaction structures, and provide an understanding of how those typical transactions are taxed for both a buyer and for a seller. And then in the back half of the presentation, we are going to examine some alternative structures, some creative mechanisms that can be used to kind of bridge gaps in tax treatment between buyer or seller, or that are utilized in specific scenarios in order to achieve the best results when those standard typical transaction structures may not be the best options. So to start out, probably a refresher for most people, but if not, just to kind of lay out a reminder for those who are familiar or those are not, just because we will be mentioning these different types of entity structures throughout the presentation. And we just want to make sure everyone has fresh in their mind what we're talking about and how these entities are taxed in general. So generally speaking, now obviously there's more nuance to this and a lot of it depends on facts and circumstances, but we generally have two different types of tax treatment for the different types of entities. Our general 5 types of entities that we see are S corporations, partnerships, both limited partnerships and general partnerships, of course, the limited liability company, and then what we call in tax language a disregarded entity, which generally there we're talking about a single member LLC or a certain corporations owned by certain types of trusts. And all of those types of entities are eligible for what we call pass-through treatment, which means there's no tax assessed or paid at the entity level itself. The entity is essentially disregarded, for lack of a better word, for tax purposes, and all the profit and loss of the entity flows directly through to its owners and is reported on their individual returns based on their individual tax situation, based on their income, the state or city where they're located. By contrast, we have the Chapter C corporation. That's your typical corporation, your Walmarts, your Amazons, and then anyone who forms a corporation who doesn't elect for S corporation treatment would be treated as a C corporation. And the C corporation, by contrast, is subject to what we call double taxation, in that the corporation itself pays corporate tax. And then if and when the corporation makes distributions to its shareholders, the shareholders then pay tax themselves on the distributions that they receive.
If I can interject there for a second, please, Avi. After the 2017 Act, with the reduction in the rates on C corporations, from a top rate of 35 to a flat rate of 21, and again, depending upon the type of business, we've seen a lot more C corporations come across our desks than we used to. We've also seen a lot more interest in people looking to start off as Section 1202 stock, or corporations that qualify for 1202 stock treatment. Again, when the rates were 35%, it wasn't a very attractive option for many folks. Now that it's finally down to something that's more in line with the rest of the world, at least for now, we're seeing a lot more interest in that.
Yeah, and this, Lou mentioned the QSBS treatments under 1202, which allows a C corporation stock that's originally issued to an owner to be eligible for significant tax savings upon sale if you hold the stock for 5 years or more, and certain other requirements have to be met. So there's a huge advantage there. C corporations are also extremely popular and common in the startup high growth world. Anyone looking to eventually raise venture capital money. And one of the reasons there is that if you're in growth mode and not planning to either generate cash flow or make distributions in the early years, the double taxation is not as scary, because double tax of 0 is still 0. If there's no profit, it doesn't matter how many times they tax you. Okay, so that's kind of just a real intro, just to remind ourselves of the different entities that will be coming up and how they're treated. Of course, as we talk about them, we'll probably remind ourselves of this treatment, but just to lay out the land. So now when we jump into transaction structures themselves. So if I am looking to buy or sell a business, and for our purposes, we are going to be focusing exclusively on private sales, which is why we're really going to be focusing on the first 2 items here. But we generally have 3 options, and you'll see option 3 kind of has 2 options within it. So option number 1 is I can buy or sell the stock of the company. And this is typically what people think of when they buy a company. Anyone who's like in the investment world, if you're buying something, it means you're buying the stock, right? You're going onto a public market, and there's shares of Apple, there's shares of Walmart, and you are buying shares that are currently owned by one shareholder, and now you're going to become the new shareholder. But the main alternative to what you can do to structure a M&A transaction is that instead you can buy the assets of the company. And we'll see some illustrations as we go on the couple next pages in terms of how these actually look and work in practice. When I try to explain the differences of these two to clients, I like to often explain it in terms of soup. Yes, soup in a pot that cooks on your stove. And not just because we got the word stock in there and it's a pun, but if you think about buying the stock of a company, you got a pot of soup. It's got all the good stuff in there. Let's say you got a hot piping chicken soup, and you got your chicken in there, you got your broth, you got your carrots, you got your parsnips, you got your zucchinis, and whatever else you may want to put in there. If I'm buying the stock, I'm basically just taking the pot. The entire pot that was yours, now it's mine. If I'm buying assets, think of it as the way that you can take a ladle, right? An asset sale means you're using your ladle. It means you're going into the pot and you're scooping out the parts of the soup that you want, and you're leaving behind the parts of the soup that you don't want. And you're taking that and you're pouring it into your own pot. When it comes to a merger, and again, these are very popular in public transactions and much less common in private company sales, you're basically smashing your soup together with the other person's soup and combining them into one. So basically, I have a soup, you have a soup. I'm going to either pour your soup into mine, or you pour my soup into yours, and now it's all mixed together. Hopefully, it's the same type of soup. Hopefully, they go well together, but that's essentially what you've done. So those are our three basic transaction structures.
Can I jump in there again, Avi? I'm sorry. Soups aside, right? It is still possible to complete a merger without necessarily mixing the soups into one pot, right? You can have a subsidiary beneath the acquiring corporation. It could be a newly formed corp. It could be a single member LLC, and you'll have the target company merging into that entity. Okay.
Yes. Yes, what I was describing is actually what we normally refer to as a direct merger, right. Where you kind of have two operating companies and they merge directly into each other. And that's actually pretty rare for all sorts of reasons. But that's still the concept in terms of you combine entities and one disappears and the other one survives. But as Lou is describing, what we instead usually see in a merger context is what we either call a forward triangular merger or a reverse triangular merger. And as you'll see in the pictures that we get to in a moment, the reason why it's called triangular is because of the inclusion of a subsidiary entity that forms a three-entity triangle. But we'll get to those in a moment. So those are our 3 or 4 basic types of transactions: sale of stock, sale of assets, or merger transactions. And when we consider which type of transaction we're going to pursue on a given transaction, or which structure we're going to pursue, there are 4 main things that we want to think about as we approach each of them, because each of these can make material differences and material economic differences to our client. Number 1 is just the basic legal structure and who the parties to the transaction are going to be. When you sell stock, the parties to the transaction are going to be the selling shareholders and the buyer, whether the buyer is individual buyers or a entity buyer. As we said, I own stock in the company. I want to sell that company to Lou. The parties to the transaction are going to be me and Lou. I'm selling stock. Lou is buying stock. Today I own the stock. Tomorrow Lou will own the stock. When it comes to an asset sale, however, the parties to the transaction don't necessarily need to include me as the shareholder who owns the company. It usually may for other reasons, relating to non-compete obligations and representations and warranties. But for purposes of the meat of the transaction itself, the shareholders are not really a party to that. Rather, the main selling party there is the corporation, the target company itself. The target company is selling its assets to buyer, whether that's an individual buyer, more commonly it'll be an entity buyer. So the real entities are the kind of like the current target and the new target are really the parties. It's in more of an entity to entity transaction.
Although, like Avi said, there are going to be situations where the individuals, the owners, are involved because they will have assets that they own personally or through a different entity outside of the operating business. Okay, it's usually real estate, but sometimes you'll find intellectual property that they've owned outside the company. The real estate is something that we see very often, certainly among closely held businesses, because folks like to have that in their pocket even after the transaction where they've sold the assets of the operating business. It provides a nice annuity. And when you've got a PE firm that's the buyer, right, as opposed to someone of a more strategic nature, they're going to want that location. They're not going to try to consolidate the target with their own operations. So,
yeah. The next thing, and we could kind of almost talk about these together, is the transferring of title to the assets of the target and the assumption of the liabilities of the target. So when it comes to selling stock, what do you have to do to transfer title to assets or to cause the assumption of liabilities? The answer, generally speaking, is you don't have to do anything because you're transferring the stock itself. So if we have a company, XYZ Inc., and I own it and I want to sell that to Lou, just by me transferring the stock to Lou now owns the assets and the liabilities and everything that comes with it, purely by operation of law. We have a vehicle that is titled to XYZ Inc. We have a contract that's in the name of XYZ Inc. Those stay right where they are. All that has changed is the ownership on top of that entity. Nothing else has to move below at the target level. However, when it comes to an asset sale, that's not the case because, as we said, we're basically transferring the assets from current entity from the target to a new buyer entity, which means that we need to have some mechanism by which those vehicles, those contracts, employees, other assets get legally transferred. Now, that usually happens through a simple document or two called a bill of sale or an assignment or assumption agreement. But the more important point is that depending on the types of assets that you have, it may and often does require third-party involvement to transfer those assets. For example, if you have equipment that is subject to a lease, you may need to get the consent of the lessor to transfer that equipment. If you have contracts that require assignment, you're going to need to get consent from, most often the basic example is you have a landlord who needs to consent to the transfer of the lease, but the same can be the case for customer contracts, vendor contracts. Permits can often be a big sticking point in terms of having to get consent from a governmental entity to transfer those. Anytime you're dealing with asset sale, one of the first things that's important to do is to make sure you have a good understanding of if there's any roadblocks in the way of transferring those assets. Likewise, when you buy stock by operation of law, you assume all of the liabilities of the target because you're just taking the target company by purchasing its stock. The liabilities were there yesterday, they're still in that entity today, and now they're yours. By contrast, when you buy assets of a company, other than several areas of law where there is a concept of successor liability, like tax and employee benefits and environmental, which you always have to do extra diligence on to understand. But as a general rule of thumb, you do not assume liabilities unless you explicitly agree to do so. So the lawsuit that occurred that's still pending, that happened on seller's watch, you can leave that with seller, and it's their obligation to defend it and handle it. If they sold product or provide services before closing and someone comes out of the woodwork and brings a claim related to that, you take the position that was a claim against XYZ Inc. We bought the assets of that company in ABC LLC, and we have nothing to do with you. You get that thrown out of court in 2 minutes usually. So from a corporate legal business standpoint, understanding how the assets and liabilities are going to be transferred, if at all, is paramount in deciding which structure to pursue. And of course, last and certainly not least, both for the transaction itself and certainly for today's presentation, is the different tax treatment that you're going to incur based on whether you are buying or selling assets or liabilities, and or merger. And then just to understand the merger standpoint, actually we'll do that when we get to the picture. So just to kind of illustrate what we've been talking about, maybe we should have done this sooner, but this kind of helps you visualize what we've been talking about. So here we have target shares own, kind of view me. Target shares is the shareholder. Shareholder owns this target company. Target stays where it is. All that happens is target stock goes to acquirer. Acquirer sends money to owner of the target shares, and now target essentially will move underneath acquirer after this transaction in exchange for the money. By contrast, when we deal with a sale of assets, we have these arrows in a different place. The selling shareholder, target shares, is not really relevant to the transaction itself. The transaction is happening between target and acquirer. So target sends its assets over to the acquiring party. Acquiring party sends money to target. And then usually what you would expect is target is going to distribute those funds up to its shareholders, usually almost immediately. But depending on what target is, target might be an ongoing business that's going to continue operating and selling only a division. It may keep the money where it is. But generally speaking, you're then going to see a distribution of funds up to the owners.
It's also a question, Avi, if the payments have been made on a deferred basis or are being made on a deferred basis, whether that's through a promissory note or otherwise. So
Yep, very true. Okay, now we have our mergers. So as we mentioned, here's your triangle form. This is why it's called a triangular merger. Our more common version is what we call the reverse triangular merger. And what happens is the acquiring company will form what we call a merger sub. It's not going to be a wholly owned subsidiary. Usually it's going to be an LLC, but it can be a corporation as well. That merger sub LLC will then merge into Target with the Target as the surviving company. So that after the merger occurs, you see our post-merger diagram, the separate existence of merger sub goes away. All that we are left with is acquirer as the 100% owner of Target. By contrast, our forward triangular merger is essentially the opposite. Acquirer sets up merger sub same way, but instead of merger sub going into Target, Target goes into merger sub, and merger sub survives. And merger sub now, again, Target disappears. Merger sub is all that's left, except now merger sub acquires by operation of law all of the assets and the liabilities of the Target. And then, for all legal purposes, and we'll mention stock tax treatment briefly, but for all legal purposes, a merger is essentially the same as a stock sale in that you subsume all of the assets and liabilities automatically. You don't get to do the picking and choosing and leaving behind liabilities or leaving behind certain assets that you don't want. Everything comes along with it.
Again, that's in the case of a reverse merger. Okay, it's treated like a stock sale. It's usually used where we have some difficult shareholders on the target side who don't want to go along, and there's nothing in the shareholder agreement to compel them to go along, like a drag along. So the importance of a shareholder agreement cannot be stressed enough.
Yeah. As Lou was saying, the reason why and this is actually why it's often used in a public company context is that in order to do a stock sale, you generally speaking, because every person owns their own stock, so in the absence of something that compels them, you can't force someone to sell their property. At least not yet. We'll see what happens. So what the merger statutes allow you to do is by majority vote or supermajority vote or with the consent of the board of directors, depending on what your charter documents say and depending on what jurisdiction you're in, the shareholders by a certain threshold of vote can compel the company to merge, which effectively accomplishes the same thing as a stock sale, but using a different form. In a merger, certain shareholders may have objection rights or dissenters' rights and ways to get out of it. But the point is you can still affect the transaction in a way that you wouldn't be able to accomplish a stock sale without those people's participation. So again, it's less common in the private company sale. In public company, you have to do it because, think about how many stockholders you would need to get on board to sell a public company if you needed everybody to sign a stock purchase agreement. It would be impossible.
I mean, it's effectively a squeeze out. because once a shareholder exercises those disinterest rights, their appraisal rights, they cease to be an equity owner. At that point, they take on the status under state law as a debtor, as a creditor of the corporation. Okay, so it's a nice way of pushing people along.
Yeah. Okay, so those are our three types of transactions. We are really going to be focusing for the rest of the presentation, as I said, on the first two, sale of assets, sale of stock, because those are more common. To the extent you're dealing with a merger, for purposes of tax, a reverse triangular merger is going to be treated as a sale of stock, because that's essentially what it is. The stock is transferring from current owner to acquirer. A forward triangular merger is treated as an asset sale for tax purposes, because the merger sub is the survivor, and it's really, for tax purposes, viewed as an acquisition of the assets and the liabilities rather than the stock. So when we talk about sale of assets, sale of stock, for tax purposes, keep in mind that each of these types of mergers fall under one of those categories, even though we're really just talking about asset sales and stock sales. So when we talk about tax, the key tax principle to keep in mind is that from a pure economic standpoint, the quicker that a buyer is able to recover its purchase price, that directly leads to the deal becoming less expensive for them and more opportune for them. And one of the main ways that they can do that is through tax treatment, which we will obviously get into some of the nitty-gritty and details in a moment. But our general rule of thumb, and this is both because of tax and also because of other reasons, is buyers prefer asset sales, sellers prefer stock sales. We'll see why with the tax in a moment, but just thinking back to what we just talked about earlier, the main reason why, apart from tax, that a buyer prefers to do an asset sale is because of the liability treatment. The ability to say that I'm starting fresh with a new company, all liabilities of the past are staying behind with the seller. I don't have to worry about something that might have gone wrong years ago. I don't have to worry that they have some debt they didn't tell me about, or some litigation that's in the pike. That's going to be their problem. I'm starting day one with a new company, just with the assets, and maybe certain liabilities that I've specifically agreed to take, but any unknown liabilities, any unassumed liabilities, they stay behind. Obviously a huge advantage from the seller's perspective. Seller, again, apart from the tax treatment, they're happy to send all the liabilities away and not have to worry about them. So they obviously, even just from a legal perspective and not even from a tax perspective, prefer to do a stock sale if they can. But for purpose of this presentation, this rule of thumb is going to be even more true for tax treatment. Buyers prefer to buy assets, sellers prefer to sell stock, and we'll examine kind of different differences and some of the ways that we can bridge those differences later in the presentation.
I'm just going to jump in here real quick.
Yeah.
To give the code for those who are taking this program for credit. So if you're an accountant or attorney who's taking this program for credit, please write this down. The code is A10. Again, A as in apple, the number 1 and the number 0. One final time, A10. Back to you guys.
Yeah. Okay.
If I could jump in there again, Avi, just for a second, I keep interrupting, I'm sorry. On the asset sale, we're assuming here that we've got unrelated parties, okay? It's an arm's length transaction, fair market value is being paid. We've often encounter situations where folks try to argue, well, there's de facto merger here, and you push them on that. How is it de facto merger? We've got different parties on both sides, I mean, different owners, with arm's length transaction, fair market value purchase price. There's no need to be concerned that you're still going to, as an asset buyer, be hit with the income tax liabilities of that target. The one exception is on the sales tax on New York, and though we're focusing on the federal tax consequences here, there is a bulk sales problem in New York that if you acquire the assets and you don't get clearance from the Department of Taxation before doing so, you may be responsible for the sales taxes associated with that business that have not been paid. So just something to be aware of.
Yeah. All right, so Lou, why don't you give us kind of the high level overview on stock sales and how those impact both parties?
High levels are good.
Yeah.
Although when you fall, it's that much worse. Okay, sale of stock, 99.99% of the times our seller of stock holds it as a capital asset. Okay, they're not a dealer that we're dealing with. So when they dispose of the stock, and again, assuming that they've held it for more than a year so that it's treated as a long-term capital asset in their hands, they're going to get preferred treatment on the federal side. Okay, whatever gain they recognize is going to be taxed at a 20% federal rate. Okay, just to stick in some state and city things here, state and city do not distinguish between capital gain and ordinary income. Okay, the amount of gain is an interesting point because it's going to vary from shareholder to shareholder, very much dependent upon when and how that shareholder acquired their shares. So you're going to have situations where, especially in the closely held, where shareholders are comparing notes, and you've got some people who are going to be paying a boatload of tax because they were the founders, and others who may receive it as compensation, under Section 83, others who inherited, those lucky bastards. I'm sorry, did I say that aloud? Those lucky folks who inherit from a decedent and now have a stepped up basis, preferably closer to the sale than not. So you're going to have very different economics here, and that can play out in the relationships here. It sounds silly, but it actually happens. So another distinction, and this depends upon whether you've got an S corp or a C corp. Anytime an individual, and we're assuming individuals, trusts, partnership types here, at least on the C corp side, anytime one of them sells stock in a C corporation, if they're not materially, I'm sorry, in an S corporation, if they're not materially participating in that S corporation's activities, they're going to get hit with the 3.8% surtax on that investment income. If they are materially participating, okay, they will not be hit with that stock, with that investment tax. Okay, another distinction between the shareholders within a single corporation. All right, on the C corp side, you don't have the problem. Regardless of how active the shareholder may be, when they dispose of their stock, taxable event, they're going to be hit with that 3.8% surtax on the capital gain. So you're not looking at really 20%. It's a given. It'll be 23.8%. All right. Again, something that you have to consider when you're running it through the economics here, which everyone should be doing in advance of signing a letter of intent, frankly. Once you've got a purchase price agreed to, you should have some sense of what the consequences are going to be. Yes, there's a lot of negotiation and things are ironed out as you go along, but you want to know in advance ballpark what your net economic result is going to be, because trying to change the deal midstream is extremely difficult. Okay. What else do we have here on the list here?
Yeah, well,
installment sales.
I just to kind of like sum up the basic treatment. So
yeah,
when you sell your stock, again, this is think of it what you own stock in a public market. It's really the same concept. Your tax incurrence is going to be equal to long-term capital gains rate applied to your gain, which is going to be calculated as the amount of money you receive, generally speaking, less the amount of money you paid. I mean, that's generally going to be your basis. There's obviously different ways that basis can change depending on how creative your accountants are, but that's the general rule of thumb. How much money did I pay for the stock? How much money did I get for selling the stock? The difference between those is my gain, and then I pay 20% on that amount, assuming that I held the stock for more than 1 year and I'm eligible for long-term capital gains. By contrast, and we'll see kind of the difference in a moment, the buyer has no ability to use the tax code in any way to recover its investment until it sells the stock. The buyer, when it sells the stock, it gets presumably gets money from its secondary buyer, but there's nothing to do in the interim. And as Lou said, it's very important for the seller perspective to keep in mind that because of different holding periods, because of different bases, every individual stockholder might be in a different position, and then of course they might be in a different jurisdiction. So all of that is going to impact their ultimate tax treatment. As Lou said, C corporations are on the downside, they can be subject in the scenarios that he described to the additional 3.8%, but on the bright side, they can be eligible for the tremendous benefits where what is it? You get to deduct what the first 10 million, 5 million of gain
on the 1202.
Yeah.
10 million.
So first, yeah. So there's ways of, if you qualify, the first $10 million of gain gets disregarded, and you only pay tax in excess of that. So it's a real beneficial structure if you start out as a C corp and hold a stock for more than 5 years to really achieve a tremendous tax result.
Again, assuming original issuance and all of the requirements are met. Yes.
Yeah. And while we mentioned that in a stock transaction, the target itself is typically not going to be a party to the transaction. The type of entity, depending on history, there can be consequences to the target itself. Lou, I'll let you speak to those briefly.
Oh, yeah. If your target is an S corporation, I mean, you're going to be losing the S corporation status, the election, if you've got a C corporation buyer, for example, or you have a non-resident alien who is the purchaser. Although there has been talk in Congress practically every year for a few decades now to change that to allow non-resident aliens to acquire stock in an S corp, but it hasn't gone very far. The other thing here is with net operating losses, C corps can carry those forward now indefinitely, but there are limitations. Putting the 2017 Act aside, the limitation that we're talking about here is when you have a change in ownership of the corporation, as we will in this case. We're talking about a 100% change in ownership here. So the ability of that owner through the C corporation to continue using those losses is going to be restricted. It's based on the fair market value at the time of acquisition and what's referred to as a tax-exempt rate that the service publishes every month. Okay, it's published in a revenue ruling, usually the third week of the month. But that sets the cap, the amount that you can deduct in any year going forward, all right? So you may think you're getting all these losses. Yeah, you are, but they're going to be subject to at least that restriction and a couple of others on a going forward basis. One other parenthesis here for the involvement of the corporation, and it's something that you'll use where the corporation has a lot of extra cash laying around, where it may become involved in the transaction itself by using that cash to redeem stock at the same time that the buyer is purchasing the other stock. Okay, so between the corporation, which is being acquired by the buyer, and the buyer themselves, they can complete the stock transaction. It saves the buyer some money, if you will, because they're using the excess cash sitting in the corporation to complete a redemption, at least in part. So again, it's something to keep in mind when you're looking at the balance sheets here. Something in excess of working capital that you need in the company. That's a good function for it there.
Okay, so that's our general rule of thumb on stock sales. The seller gets capital gains treatment on their gain. Buyer holds the stock and doesn't recover any investment until they sell it.
I mean, just one more point here. I mean, just comparing to sales by partnerships, and we're not talking about partnerships here today, but when a partner sells its interest in the partnership, you have to look at the underlying assets of the partnership to see how many of them, if they were sold directly, would generate ordinary income, the so-called hot assets, right? To the extent that the value, the amount of the purchase price is attributable to such assets, the character of the gain is going to change in the hands of the selling partner. Okay, it'll be treated as ordinary income to the extent of the value attributable to those hot assets. S corporations are passed through, right? But we do not look through for that purpose. We do for other purposes, like basis step up. We consider that in that instance. Do we have hot assets there? But when you're talking about a sale of a business like this, no. So selling the stock goes beyond just the convenience of it. It's the nature of the gain that's underlying the entity there that's also significant.
Yeah, absolutely. Okay, asset sales, and here's the real the real magic for the buyer, and the reason
Yeah.
why buyers, from a tax perspective, always want to buy assets. The buyer can, during the course of its ownership of the assets in its new entity, has the ability to depreciate or amortize certain types of its assets, and then essentially use that to deduct and offset its income generated from the the assets over the life that it owns those assets, and it can start doing that immediately. And depending on the types of assets, there's a different depreciation or amortization schedule, whether it's 5 years, 10 years, 15 years, or more. But at almost immediately, it can start offsetting its gains by depreciating or amortizing those assets. And that's the big advantage from a buyer's perspective, in addition to the step up of basis, which allows it to have a lower gain when it ultimately disposes of the assets. Is a real advantage for the buyer. The seller, by contrast, is almost never going to get pure capital gains treatment on an asset sale. It's possible depending on the types of assets, and we'll talk about that quickly. But basically, the way it works on an asset sale is you have your purchase price, which is the amount that the buyer is going to be taxed at, and purchase price is going to be calculated. Obviously, the amount of money or other property that you receive is part of your purchase price, but importantly, the value of the assets that are the value of the liabilities that are being assumed by the buyer is also calculated as part of the purchase price, because that's value that the buyer is giving to the seller by taking over those liabilities. And when you buy assets, what you have to do is what is called an allocation of purchase price. And this requires to have a good tax lawyer or a good accountant to make sure they understand all the different types of assets, because different assets are taxed at different rates when they are transferred. You have your capital assets, such as intangibles, goodwill. What else falls into this category?
Well, the rest of them, if you have some investment assets on hand that really may be part of working capital, but aside from that, that's the extent of your capital assets. The rest of them yield capital gain. Okay, 1231 assets, basically depreciable property that you're using in the trade or business, which could be, machinery and such. It could be real estate that's used in the business. Those will get you capital gain treatment, assuming there's gain on a gain on their disposition.
Yeah. So again, depending on the type of assets that and it's, again, because you're selling assets, you're not selling stock. It's almost viewed for tax purposes as each individual asset is being sold, and each individual asset is taxed on the gain on that asset at the applicable rate that applies on a sale of that type of asset. So if it's an asset that qualifies for capital gains treatment, that the gain on that asset is taxed at the long-term capital gain rate of 20%. If it's an asset such as accounts receivable, inventory, or other depreciable assets or other ordinary income assets, those are going to be taxed at the much higher ordinary income rate, which if you're in the highest tax bracket, which if you're selling a business, then presumably in that year you will be, those assets will be taxed at 37%, which typically results in a blended rate of somewhere between 20 and 37%, depending on how much of the purchase price is being allocated to capital assets versus how many are being allocated to the non-capital assets. And there's always a point of the transaction where there is some tension here between buyer and seller, because seller wants to obviously allocate as many of the assets as they can, or at least that they can justify, to the bucket of capital assets, which means that they often will want to allocate as much as possible to what we call goodwill, which is one of those things that is hard to define for some people, but it's essentially the brand and the name of the company and its goodwill in the marketplace. And depending on the type of business, that often is all that you're buying. I mean, think about, like, you're buying a professional services business. Doesn't really have much in the way of real assets as you think of it. Its assets are its relationships with its customers, its reputation in the marketplace. So in those types of assets, in those types of asset sales, you often can get very close to a long-term capital gain treatment, because the vast majority of the assets fall into that intangible bucket. You're not selling machinery and inventory and real hard physical, tangible things. Important to note for both asset sales and for stock sales that they can be eligible for installment sale treatment if part of the consideration is going to be paid at least a year following closing, whether that's as part of a note or an escrow or
in a different tax year. Yeah.
There are rules to comply with that to make sure that you qualify for that. So obviously very important to understand and navigate those rules. But general rule of thumb in tax is you don't pay tax until you receive the money, and buyer doesn't get to deduct the payments until it pays the money.
Yeah, there are exceptions. If I can jump in here, please, Avi. We're talking about here either a partnership, really, but an S corporation in this context, because that's where you have individual shareholders or people who are treated as individual shareholders for tax purposes, and they have the distinction in the rates that apply to them. Okay, if you're talking about a C corp, there's a single rate that applies regardless of the nature of the assets being sold. Okay. It may matter in a C corp if you've got capital loss carry forwards. That's a different story, okay? Because then that can be used against capital losses. Capital gains, rather, forgive me, against capital gains. Okay, you got a 5-year carry forward in that, assuming you have anything left from your 3-year carry back. But in that case, it'll matter to a C corp. Aside from that, not really. Okay. On the installment sale, again, this matters to both types of entities, S corp and a C corp, depending upon the asset being sold. Certain assets do not qualify for installment reporting. All right, so things that would generate ordinary income, for example. The big thing that we always encounter are 1245 assets, meaning depreciation recapture assets. It's non-real estate assets that you have depreciated, and you're recapturing the amount of that depreciation as ordinary income. It's a timing thing. You get the deduction up front, but on the back end, you recover it as ordinary income. To the extent you can keep your allocation to those types of assets, to the remaining book value, to the remaining basis, you don't have to worry about it. But then you've got the tension between the buyer and the seller there, where the buyer knows they can recover their purchase price much faster on that type of an asset. Okay, not just through depreciation, but at least for another year, 2 years actually, you have the ability to expense the cost incurred in acquiring certain assets. Okay, there's bonus depreciation. Once upon a time, was limited only to new acquisitions, to new assets that you're placing in service for the first time, but was extended to cover used assets, if you will, like here, where you're buying from a business. Okay, that's been phasing out after 22. So right now, I think you get to write off 40% this year of your cost for that type of an asset. Next year it's 20%, and then it goes away. But I think both parties in Congress are in favor of extending that benefit. Was there anything else on that slide that I did not touch upon, Avi, that folks may want to know about here?
No, I think we got it.
Okay.
Yeah, with the remaining time we have left, which unfortunately is less time than we had hoped, we're going to quickly run through some alternative transaction structures that can be utilized to create tax efficiency or to harmonize buyer and seller positions. There are scenarios where, for either business or practical reasons, utilizing a pure stock sale or a pure asset sale doesn't work. Most common is where buyer wants to still buy the assets because of the tax reasons, but they have to buy the stock for other reasons. Most common scenario is, we talked earlier about, you have all these contracts or permits that you have to get consent to assign, and either A, maybe there's just such a huge number of contracts that the process of going to get all those consents is just going to be impractical, or as a matter of reality, certain contracts, certain permits are just not assignable. Certain, I've definitely dealt with permits in like heavily regulated areas where the government will just, they do not allow that permit to be transferred. The buyer would have to apply for their own permit if they wanted to buy the assets, and sometimes that could take years to get. So that will leave them with no alternative other than to just buy the stock, so that they step into the shoes of the seller and have access to that current permit, which is registered in the name of the seller entity. also for other reasons, they may want to maintain the EIN of the seller. Kind of similar scenario where the EIN is recorded as being tied to a certain permit, a certain contract, and there's no way to change that. And then finally, these can also be used as a way to bridge the gap between buyer and seller, because let's say the seller is insisting on capital gains, the buyer wants to buy the assets to get its tax results, and other than just increasing purchase price, there's really no way to accomplish that through your traditional methods. So the three alternatives that we're going to quickly run through are those provided under IRS codes 338H10, 336E, and 368A1F. Yeah, they couldn't make this one simpler. And that's colloquially known as the F reorganization. So the first one to be passed into law was Section 338H10. And this is not always, but typically used when we're dealing with a target S corporation. And this is a joint election made by both the buyer and the seller as part of the transaction documents, where they're both agreeing that, notwithstanding that for all other purposes, legal and otherwise, we are treating this as a sale of stock. For tax purposes, we're going to treat this as a sale of assets. And buyer and seller will participate in a fiction that we are doing an asset sale, even though on paper, everything else looks like a stock sale, and they will be treated as a sale and a purchase of assets only for tax purposes. Now, Lou, if you want to run through some of the requirements to be eligible.
Yeah, to save time, I may actually combine H10 and E here together. Like obviously H10 has been around for some time. It applies where you have an S corporation target, so you've got individual shareholders, let's say, or where you have a consolidated group or an affiliated group or C corp, where you're buying from a parent C corporation. Most of what we see is on the S corporation side. You buy the stock, it's treated as if the target company sold its assets in exchange for whatever the consideration was, plus liabilities, okay, because we're treating it like a real asset sale. And you look at the regs under 338H10 and they tell you, pretend this is a real asset sale if you had to interpret some ambiguity in the regulations. So
let me tell you, when you're dealing with a tax lawyer on one of these, they will keep referring it to as an asset sale, and it'll drive you crazy.
Oh no, I'm pretty good about that. Because
they'll keep calling it an asset sale, and you'll say, no, it's a stock sale.
Fine.
They only talk in tax.
Anyway, the point here is that you have to consider also the liabilities, because they're deemed to have been assumed or taken subject to, notwithstanding that you're actually acquiring the stock of the corporation, okay? So that's added into the consideration, much as it would be in an asset sale where you're assuming or taking subject to liabilities around those assets, right? And after that, the target is deemed to have liquidated. That's how the fiction works to get the consideration up into the hands of the shareholders who really sold their stock as a matter of state law, as a matter of contract, okay? You may have gain on the sale of that stock, on the liquidation of that stock. But first, depending upon the nature of the assets, the gain flowing through, we're assuming an S corp, the gain flowing through may be ordinary, it may be capital. That's added to your stock basis, okay? Your deemed investment in your stock. When the distribution then is made, and again, this will depend upon where your starting basis was as a shareholder. When the distribution is made in liquidation, in the deemed liquidation, you may have additional gain there as a shareholder that you'd have to pick up. One thing that we will often do, and Avi mentioned it there at the bottom, that gross up language, we'll try to determine how much would you have received, you the seller, net of tax, if you had sold your shares. And now how much are you going to get by accommodating the buyer here and agreeing to make the H10 election? And we went through that and we determined a gross up amount that the buyer would have to pay to get the shareholders who are selling their stock the same economics as they would have had on a straight stock sale. And it has been rare in my experience for the buyer to push back on that. The allocation of that additional payment, the gross up, is going to be allocated to goodwill more likely than not. So they're going to recover it, albeit over a longer period. The goodwill is 15 years write-off, okay? But again, it's a joint election, so the buyer has to get the seller to go along. If the buyer cannot, they're not going to get their election. Again, the importance of the letter of intent. This is not something you leave at the end of the day, something that should be discussed up front. You're not going to start off the marriage very well if this is something that you introduce on the night of the closing. Okay, 336E. Whereas on the H10 side, we have to have a corporate buyer, single corporate buyer acquires, again, the 80%, but practically speaking here, we're talking about acquiring 100%. Technically, it's over 12 months. We're going to do it in 1 day. On the E side, this thing came in about 30 years ago, more than that actually now, 30, 40 years ago. We didn't get regulation until about 3 decades later. And it pretty much parrots what you see on the H10 side. Again, a deemed sale of assets, followed by a liquidation of the target corporation up into the shareholders. Okay, so much pretty much the same. Same type of target. It's either an S corporation or an 80% C corporation, 8% owned by, at least 80% by a corporate parent or part of a consolidated group. The difference is the nature of the buyer. You can have multiple buyers, okay? You can have a partnership as a buyer. You can have individuals as buyers. So it's a very different set than you found in the H10 side. I'm not sure why it took them so long to figure out, them being Congress, why it took them so long to figure out that this is something that non-corporate buyers would also benefit from, because they face the same hurdles as would a corporate buyer, where you've got so many assets or difficult to transfer assets. Let's try to accommodate, let's try to reconcile those two goals of the buyer and the seller. In both situations, the stock sale is ignored. Okay, there's no gain generated from that. The gain is on the deemed liquidation, and of course the pass through on the S corp side, if that's what we're talking about. Installment reporting is possible. Okay, there are rules under the 453 regs, the installment regs for installment reporting. I think it's the -11 regs, where with an S corporation at least, if the liquidation occurs within 12 months after the adoption of a plan of liquidation, the S corp can distribute an installment note up to its shareholders without accelerating the gain associated with that. C corp can't do that. It will accelerate the gain that's otherwise being deferred, as Avi explained earlier, on the installment note, right? Where you don't get taxed, you don't recognize the gain until you actually receive something. What else do we have there, Avi?
Yeah, that's
the F reorg. The F reorg is a wonderful
reorg.
thing, especially if you're dealing with a private equity firm that wants you to roll over part of your equity. Step back a second. Private equity firm buys your stock. Let's say it qualifies to make an H10 election or to make a 336E election. I should add, by the way, that the E election, the buyer's not involved. Okay, it's something that's done. Yeah, something that's done on the seller side. So again, if you're preparing documents, you want to make sure from the letter of intent stage that the seller is going to agree that they're going to make the election. Or if you don't want them to make it as a buyer, you make sure that they're not going to make it, because again, it's something that's done strictly on the seller side. You want to be careful of where you're going. You want to know where you're going to end up in advance. All right. But let's say in each of those situations, you can't cherry pick what's being transferred over, right? You have gain, you're deemed to have sold all your assets, not just part of them. So the idea of being able to defer part of the gain by rolling over a piece of it into the PE firm, okay, or any other firm that may be interested in, having you keep some skin in the game on a pre-tax basis, which is clearly what the selling shareholders would prefer. Along comes the F reorganization that's been part of the code for a very, very long time, but has seen a resurgence once the PE firm started buying up everything under the sun, from your dental practices to your whatever else you want to think of. Anyway, that's what they do.
The F reorg is really, the best of the bunch. It offers the most flexibility. It offers
very much
the most advantages. Everyone really gets to have their cake and eat it too. The buyer gets to get their asset sale treatment. The seller gets their stock sale treatment. And as Lou said, it also facilitates the ability to do a rollover, which is increasingly common, especially in the private equity context. They don't want to, they're not going to pay pure cash. They almost always want the seller to roll over at 10 to 20% of their consideration into the buyer entity or into a holding company. So that way they're motivated to keep growing the company. Also, because private equity firms or other entity buyers are not permitted under the tax law to be S corporation shareholders, it also obviates that problem. As we'll see, I'm going to just quickly run through how an F reorganization is mechanically accomplished in the next two slides, and we'll try to limit that to 2 minutes and end this. And it's very important, as many of us have learned on some recent transactions, to do this very carefully and timing wise. There's a very specific way this has to follow, and if you do it incorrectly, you can blow the whole thing. But essentially, we start off with our shareholders who own our target S corporation. The step one is that the shareholders do what is called a contribution of shares. They form a new S corporation, and they contribute their shares in the target to the new S corporation in exchange for the shares of the new S corporation. So they basically slide in this new co as an indirect owner. So now, where we originally had shareholders owning target, now we have shareholders that own Newco S corporation, which then in turn own the previous target corporation. So we have a 3-tier structure now instead of 2. In step 2, Newco then elects to treat the target as what's called a Q sub, which causes a deemed liquidation of the target's assets and liabilities into Newco. For tax purposes, again, the assets and liabilities for all legal purposes are still in target, the Q sub, but for tax purposes, they've all moved up here into Newco, which is what achieves the result that we want. And then the next step is that the target essentially converts into an LLC. In most jurisdictions, it's not so simple. In Delaware and in California, for example, there is a conversion statute which requires you just file a piece of paper and then proof what was an S corporation is now an LLC for all purposes. In most states, that doesn't work. New York, for example, has no such statute. So instead, we go back to our good old friend, the reverse triangular merger. So we form a new LLC. That's going to be our merger sub. We merge the new LLC and the target together, and the resulting corporation is the LLC. So now we end up with shareholders who own Newco S Corp, which in turn own new target company LLC.
Two quick points here, if I may, Avi. Yes. First, when you have the Q sub election, once you're there, if there are any assets that the buyer's not going to want or that the seller wants to keep with the buyer's permission, that's the time to distribute them out of the Q sub up into Newco, because it's a non-event for tax purposes. Okay, be careful on the state side, but for tax purposes, it's a non-event. That's time to do it. I've had that with environmentally challenged real estate, for example, where we had in the target. That's how we removed it out. We deeded it out to the Newco. I don't know why it was still in the same company as the business, but it was. Also on this side, an important point: the EIN carries over from the old S corp to the Q sub to the new LLC.
Yeah, and then our final step, which should say step 4, but says step 5, the Newco can now sell the LLC interest to the buyer, which accomplishes everything that we wanted. So now buyer gets to treat all of this as an asset sale. The seller has accomplished its stock sale treatment through the deemed liquidation, and now its ultimate sale of LLC interests. And now buyer can take hold of LLC interests rather than S Corp stock, which it cannot own. It also allows you to facilitate a tax deferred rollover that allows seller to take a piece of buyer interest on a going forward basis without paying stock on it until it has a liquidation event.
The S corporation, the Newco would transfer over, it's a 5 to 20%, depending on the situation, of its membership interest in the new LLC up into Newco there, which may be a partnership, okay, with the PE fund, or especially set up partnership for acquisitions, because you want that to be a tax-free rollover, okay? Into a corporation may be difficult because they probably won't qualify under 351, right? You're not going to get 80% control of that entity. But the balance of the membership can be sold and it will be respected as a sale of the assets, okay? Whoever gets the rollover interest, the rollover contribution is going to drop it down into the acquiring entity anyway here. So,
right. So with that, that's the end of our presentation. I know we threw a lot at you, especially in that back half. So if there are any follow-up questions or anything you want to discuss further, please feel free to reach out to either of us. We're happy to be a resource going forward for any questions you may have on this subject matter or otherwise, and don't hesitate to reach out. So
great. Thank you so much to Avi and Lou. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, again, please feel free to reach out directly to Avi, Lou, or myself where appropriate, and I'll be sure to include their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 4 more quick items before I let you go. First and most important, later today, you'll receive an email from me with an evaluation form for the program. It'll ask you to input the code that I mentioned here today in order to receive your credit. After that is submitted, in the coming days, you'll receive an email from ACE Seminars with your certificate. Again, please keep an eye out for an email from ACE Seminars. If you don't see that email in the next few days, be sure to check your spam folder. Again, the email with your certificate will not be from me. It will be from ACE Seminars. Second, my next webinar is on Friday, February 28th, featuring Kevin Matz, a partner at Aaron Fox Schiff in New York. He'll be speaking on the topic of highlights of the 2025 Heckerling Institute on estate planning. I'll be sure to include to send out the invitation to this program in the coming days. In the meantime, I'd love to continue to grow this webinar community. So if you have a friend, colleague, or client who'd like to be notified of my upcoming webinars, they can email me with the word webinar in the subject line, and I'll add them to my webinar distribution list. My email is jonathan@parkbridgewealth.com. Third, you can follow all my work on X and Instagram at Jonathan on Money. And by connecting with me on LinkedIn, you can also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week, by following me on YouTube at Jonathan on Money as well. And fourth, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees, and I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.